When financial markets are rising, it's easy to be excited about how much money you're making. The exhilaration of seeing your investment account swell in value can be very heady indeed. On the other hand, watching your account balances fall can be very depressing and even cause significant stress. If you're going to have investments, you really ought to consider the impact of capital preservation math. Now, there are three keys to understanding the impact of capital preservation math. Key number one, gains are easier to lose than they are to make. For example, if you invested $1,000 and it grew over time to $1,500, you would have a 50% gain. That part is easy and exciting. Later, if your $1,500 investment fell to $1,000 in value, you just lost 33% of your investment value. In other words, it only takes a 33% loss to fully wipe out a 50% gain. So key number one for capital preservation math, gains are easier to lose than they are to make. Key number two, losses are hard to overcome. Here's an example. Suppose we made a $1,000 investment and over time the value of that investment falls to $500. We just lost 50% of our investment. However, we will now have to make a 100% gain on our investment just to get back to where we started. It will take a 100% gain to make up for a 50% loss. So key number two for capital preservation math, losses are hard to overcome. Key number three, mitigating large losses can help provide outperformance over time. Based on researching investment performance over long periods of time, the general return pattern that helps us win over the long term is we need to outperform in weak markets and keep up in strong markets. Over longer periods of time, this puts capital preservation math working in our favor. For example, let's look at one of the most difficult market periods in recent history. In the fall of 2008, we had a market meltdown of major proportions. Just about every investment category lost money, and this gloomy, dark financial cloud spread all over the world. Lots of people lost lots of money in the fall of 2008. In fact, many people began to talk about the 2002 to 2012 period as a lost decade because of how the decade had performed overall, how bad the losses were in 2008, and how painful the recovery has been. And yet, suppose we owned an investment that had only done okay during that 10-year time period. This investment would have slightly underperformed its benchmark or maybe just kept up in the years 2002 to 2012, except for 2008. In 2008, this investment lost some value, like most everything else at the time, but it lost substantially less than most. In other words, this investment outperformed in weak markets, meaning it lost less than other similar investments at the time and just kept up in stronger markets. The end result would be that the 10-year performance would actually likely exceed a benchmark index even though we slightly underperformed or just kept up with the benchmark 9 out of the 10 years. Losing less or not losing at all is the key to understanding and benefiting from capital preservation math. The point is we don't have to make big, spectacular returns on our investments in order to win over the long term. We don't even have to outperform every benchmark every year. We just need to make sure that we're well diversified and adequately protected from a downturn so that we either don't lose or we don't lose as much in falling markets. Slow, steady, positive returns coupled with little or no losses along the way will win over the long term. Chasing after the big win, taking excessive risks, has the potential to hurt you in the long run. Remember the three keys to winning with capital preservation math. Key number one, gains are easier to lose than they are to make. Key number two, losses are hard to overcome. And key number three, mitigating large losses can help provide outperformance over time. We want to outperform in weak markets, keep up in strong markets, and that will help us win with our investments over the long term. And winning over the long term is what you want, isn't it? We'll have more for you in another installment of the Financial Briefing.